So now I welcome very senior professional, very big boss of enterprise performance management, Gary Cokins. Uh, so let me introduce very quickly. The topic today we are talking is predictive accounting, driver-based budgeting and rolling financial forecasts. This topic only can be delivered by Gary because he's the father of this topic. So let me give a quick introduction. Uh, Gary Cokins brings a wealth of experience to the table with a diverse background spanning over 3 decades, starting as a financial controller and operations manager for 10 years. He transitioned into a successful 15-year stint as a management consultant with Deloitte, KPMG, and EDS. For past 16 years, Gary has been associated with SAS, a prominent business analytics and intelligence software vendor, where he has earned international recognition as an expert speaker, author, and consultant, specializing in enterprise performance management and business analytics and methods and systems. So welcome, Gary. So I still remember one event where I attended your event, I think in 2014, when I came back from Saudi Arabia after my corporate career. So it was, I still remember. So you were talking about management accounting at that time, especially costing. Okay, so activity-based costing. So that was very insightful. So now, welcome to you and good morning to you. So thank you for joining all the way from United States. Over to you, Gary, sir. So please feel free to introduce yourself.
Okay. Thank you, Sheikh. Let me try now to show my screen. I'm going to hit the present. Okay, share screen. Share screen. I do have my PowerPoint open. You may have to get me through this.
Mm-hmm. Deep, would you like to?
It's saying I've had Chrome tab window entire screen.
Yes, you need to choose the tab window. Just choose window tab.
A
and you
window.
will have a list of,
Oh, good. There it is. Now I'll put it into
share.
Can you see it?
Not yet. It will come up. Just a second. Yeah, it is coming up. There it is. But you have chosen the file which is not in presentation mode. So you need to choose the one which is in presentation mode, which is in slideshow basically.
No, it is in presentation mode. I just advanced
the one which is. I'll remove it. Please try to share it again.
Do you see my bio?
Yes.
Okay, well then I'm in the right mode. Now I'm back to the title slide.
Right. No. See. So when you put the presentation in slideshow, there will be two different files. They both are not the same. You need to choose the one which is in presentation mode, which is in slideshow. So I'm removing it again.
Put the slideshow.
It's in the slideshow mode right now.
I think we lost
Gary. You can share Deep if you want.
No, he left StreamYard. I'm just waiting for him to join.
Can you reach me on WhatsApp or so?
Yeah, he has come.
Yeah.
I just logged in again. Can you see me or hear me?
Yes.
Yes, sir.
We can hear you.
All right. Let me go. You got knocked out. I'm going to go to present. Share screen. go to, did you say to window?
Yes.
Yeah. All right, there's my landing slide. Do you see it?
Right. Yeah.
You see it?
So right now I can see your title, the presentation title, and then your credentials.
Okay. I think I'm not going to go in. Let me go to the next slide. Do you see my bio?
Yes,
All
yes,
right.
yes. I
Then
got it. All right.
let me stay not in presentation mode. I'll just go straight from the slides. Okay.
All right, no problem. Please start off.
All right. Well, it's 7:45 here in the US in the morning. I have 60 minutes and it is a
Yes, sir.
long presentation. There may not
Mhm.
be time for questions at the end. So what I encourage people that would like to inquire with me, write my email address down. It's there, gcokins@garycokins.com. And also, if you go to my website, above that, below the horizontal tabs are a lot of free articles that I've written. You don't have to pay for anything. So 60 minutes, let's go.
Good luck, sir. Thank you very much.
Great. All right. Well, thank you for the introduction. Just to add a little bit more, I did receive my industrial engineering and operations research degree from Cornell in 1971, and then my MBA from Northwestern Kellogg School in 74. So if anyone's doing the math, I am 74 years old, but I feel like I'm 44 years old. I think careers have a lot more to do with luck and circumstances than being smart and competent. I had a couple of lucky breaks. That's why those books are there. And one of the lucky breaks was in 1988, KPMG struck an exclusive contract with Harvard Business School professor Robert S. Kaplan. Many will recognize Kaplan's name from the creation of the strategy map and balanced scorecard, but he did the pioneering work in activity-based costing. So I got recruited from Deloitte. I love Deloitte, but I didn't want to miss the opportunity to learn about ABC from Dr. Kaplan. I wrote a book. It led to more books, and that's the story of why there are books there. So let's go. Who will benefit from this presentation? Managers who have previously struggled at promoting rolling financial forecast as an advance to the annual budgeting process. Managers who intend to champion driver-based budgeting and rolling financial forecasts, and they need a compelling call to action. And the reason I have champion in quotation marks is because it's been my observation that although it's good to have senior executives sponsor new methods and advocate innovation, often they are preoccupied with short-term priorities and firefighting. It's typically a manager 1, 2, 3 levels down in the organization chart who are passionate and ask themselves, how long do I want our organization to continue to perpetuate using stale and arcane and out-of-date methods? And they're the ones that'll do a pilot project or a proof of concept to demonstrate to their coworkers, colleagues, and executives above them that this is the way to go. So if you are down lower in the organization chart, that's fine. I like presenting to you. So my agenda, I'm first going to give a primer on cost accounting. Then we'll move into what's broken about the annual budgeting process. And then how do we shift to rolling to driver-based budgeting, but especially rolling financial forecast. We have to talk about resource capacity planning. Remember, I'm an industrial engineer. We'll talk about that. And then a topic that's a concern for me at the end, what's taking so long for organizations to adopt these methods? I love this cartoon, drowning in data, but starving for information. You got this poor, beleaguered clerk, paper all around him, shoulders hunch. The supervisor in the doorway to the left is asking him, it looks like you've got all the data. What is the holdup? You know, I gave you the request this morning. How come you don't have the answer this afternoon? And the message to this cartoon is there's a difference between data and information. Data is typically collected transactionally, like payroll systems, procurement systems, invoicing, purchase orders, and the like. You convert that data into information to provide insights to make better decisions. I also like to start with these 3 questions. What, so what, then what? So imagine that your organization implements what I'm going to be describing in the next 50 minutes, driver-based rolling financial forecast. I say celebrate for one day. You are not done. you and your organization will see a lot more information that it's not seen before, or some of it will be different than its belief system. That begs the question, what's relevant in all this information? Arguably, the most important question is the third one, then what? Because decisions only impact the future, and that's what this topic is going to be about, the predictive view through the windshield, using an automobile analogy, not through the rear view mirror. All right, a primer on cost accounting. What this diagram is showing is that we start with the resource expenses. We then basically convert them into the work activities, and they eventually then get traced and assigned at the bottom to what are called final cost objects, outputs, processes, and so forth. The highest form of direct costing is to the left, is project accounting, but it only applies when there are non-repetitive processes and making like a single product, like a satellite. Many are familiar with the middle box, standard cost accounting, labor reporting, and routing and bill of materials. Now, I want to caution people who are in the service organizations, banks, insurance companies, don't get alienated. Don't say, oh, this is all about manufacturing. No, these are universal methods that apply to all organizations, including service as well as government. So when we move to the right, then we get to activity-based costing. I call it the poor person's, standard cost accounting system. But the message to this slide is, at the far right, what we do not want is allocations, cost allocations. We want to trace and assign with cause and effect relationships. I'll explain that in just a minute. So a simple way to understand ABC is this. Imagine you go to a restaurant with 3 other friends. You order a little salad, and the other 3 order the most expensive item on the menu. And at the end of the meal, when the waiter or waitress brings the bill, the other 3 say, hey, let's split this check evenly. How do you feel? Not fair, not equitable. Well, that's how products and standard service lines and service organizations also feel when the accountants take this large amount of indirect expense, commonly called overhead, and they allocate it to the products and service lines like spreading butter across bread using cost allocation factors like number of labor hours, number of employees in a department, square feet, square meters, number of units produced, amount of sales, head count. None of those cost allocation factor denominators reflect the unique consumption that the diverse products consume of the end-to-end business processes and the work activities that belong to those processes, which in turn draw on and consume the spending. So if you were to compare ABC, which does that, to that traditional butter spreading, you will discover that in reality, some of those products were way overcosted, 20, 30, 40%. The others must be undercosted because it's a zero-sum error game. And that means the CFO and the accountants are providing flawed and misleading information to their employees and managers. Oh, yes, it'll reconcile to the penny or euro or whatever is the currency that satisfies the external audit and the auditors like KPMG and Deloitte but it's wrong in the part. So the simple explanation of ABC is as if the waiter or waitress brings 4 individual checks. You only pay for what you consume. Now, the reason ABC has become increasingly adopted in the last several decades has to do with this diagram. It shows the 3 universal components of any organization's expense and cost structure. The direct and recurring labor at the bottom, recurring is for the service organizations, banks, insurance companies, travel agencies. The direct material in the middle, the overhead at the top. Notice that the indirect is displacing the direct over time. And when you ask people why, they'll say, well, automation, computer hardware, and so forth. That is secondary. The real explanation is over time, all organizations have had an increased proliferation of different types of products, manufacturers, more colors, more types, more ranges. The point is this: whenever you increase the diversity and variation of the outputs, it just produces complexity. And the complexity causes the need for more and more indirect expense to manage the complexity. So 30, 40, 50 years ago, when you had homogeneous products, most of the accuracy came from the direct, so you could butter spread the thin veneer of indirect. But to the right, that's not the case today. So what we want to do is convert the resource expenses, which is known, the general ledger, into the process costs and to the output costs. Now, the problem actually begins with this traditional responsibility center statement. Every manager on the planet Earth recognizes this report, salary, equipment, travel expenses. The problem is when they receive this report, they ask themselves, how much insight and understanding do I get about the cost that I can influence and control? And their answer is not much. Notice at the bottom, I say when managers get this kind of report, they are either happy or sad, but they are rarely any smarter. Activity-based costing makes them smarter. How? Here's how. Notice we've converted the 914,000 in the responsibility center statement to the middle into the language of work, key scan claims, analyze claims. And then we reassign each activity into the product, services, and customers, just like the waiter or waitress in the restaurant, based on how it's consumed. Now, when people basically start with cost accounting, they think the expenses begin on the left side of this diagram. They actually start at the right side. The products and customers place demands on the workload in the middle. The workload draws on the spending and capacity to the left. The costs measure the effect in the opposite direction. So to repeat that simply, demands on workflow right to left, costs measure it left to right. It's a principle. Rules are many, but principles are few. Principles like gravity and speed of light. You can't alter gravity, but the accountants violate that principle when they do that butter spreading of overhead. Now, I've rotated the previous diagram 90 degrees. It isn't quite as simple as, we take our ledger expenses, we convert them to activity pools and to cost objects. The right side is more realistic. Why? Because we have support departments that support other support departments that ultimately support the frontline departments that interact with customers, make products, deliver services. So it needs to be a multiple stage cost flowing. Now, I want to warn you, the next slide is going to be complicated, but after it, I'm going to point you to a link to a paper that I wrote, 30 pages, that will explain all of this a little more clearly. So here it is. Don't get upset. It's got the three universal components. We've got the resource expenses at the top, the work activities in the middle, and they eventually pile up at the bottom into the final cost objects, products, services, customers, and business sustaining. Think of all of those arrows as thin straws or wide pipes where the diameter reflects the amount of money flowing through. That's why this will always reconcile exactly to the euro, the dollar, whatever is your currency. Excuse me. If we start at the bottom, I refer to this as the predator food chain. Like large mammals eat small mammals eat plants. You'll notice that all of the costs eventually pile up into the customers and business sustaining, which I'll explain. But notice that the customers are consuming the products, but also there are some direct costs to the customers. Those are below the product gross profit margin line. A different topic. It allows you to measure and manage customer profitability, get a profit and loss statement for each customer. Now, imagine that all these arrows are now going from the bottom to the top. That's what's happening every minute, hour, day, week, month, year. The customers and the products are placing demands on the workload's drawing on the capacity and spending, the costs measure the effect in the opposite direction. So this is how we will get to the predictive view. The business sustaining is special. There are some expenses that have nothing to do with making products or interacting with customers, things like the legal department. So we can't trace or assign them to products or customers. Otherwise, we'd be overcosting them. It's typically about 10% of a company's spending. Direct cost, not broken. May have data integrity problems there. IT can fix that. I mentioned it was a complicated diagram. I'm going to presume you're going to get a PDF of these slides. You can go to that link. It's a 30-page paper titled Implementing Activity-Based Costing. What's more important is what's the result when you do ABC. This diagram, the vertical axis is the percent error compared to the butter spreading. The horizontal line is that traditional butter spreading, labor hours, units produced. The backward S line is the activity-based costing. So you'll notice what happens when you do ABC. To the left side, you'll discover, compared to the old way, in reality, those simple products were overcosted. Think of this like you in the restaurant ordering the salad. To the right side, the complex products, the other three in the restaurant ordering the expensive item, they've actually been undercosted. So there's hidden loss. And so there's consequences to this. To the left side, because you're overcosting, your competitors may price a little bit below you. They'll grab and steal market share from you. To the right side, it's even worse. The sales force is of the impression that these products are very profitable. They're not profitable. So what they're doing is the more they sell, the more you lose money. This diagram is another way of looking at the results of ABC, and you're looking at real data here. The graph at the top is typically referred to as a humpback whale curve. Notice it looks like a humpback whale. The vertical axis is the net revenues minus the properly calculated and traced activity-based costs. The horizontal axis is the cumulative buildup of the product's profitability, but it's rank ordered starting with the most profitable product, next profitable, and so on and so forth. The very last data point at the bottom right will always reconcile exactly with the P&L. In this case, 30 million in sales, 28 in expenses to net out at 2. There's always organization shock when the management team sees this graph because their belief system is it's just the blue line. Oh, we make money on almost everything, lose a little bit at the end. That's not reality. The top line is the reality. It's always a shock because notice in this case, the company made roughly $8 million of unrealized profit on 3/4 of their most profitable products. They lost $6 million on the remainder to net out at 2. And the problem was all that butter spreading was crushing and suppressing any accuracy. And the ABC methodology with the multi-stage assignment network was basically capturing it and incidentally, this graph was my very first ABC implementation in 1988, almost 3 decades. This is a real company. Now, some of you may be saying, gee, maybe we should be implementing ABC in our company. But you have this misbelief, oh, it'd be a mudslide of data. Every employee would have to fill out a daily timesheet, and employee hate timesheets. There'd be 3,000 activities. It'd be big, monstrous. It'd take us 9 months to implement it. Those are all misconceptions. I came up with a technique to implement ABC in 3 weeks. We start with model 0. It's 7 or 8 cross-functional employees in a conference room. We build a high-level ABC model quickly, not intended to have any accuracy. Then the next morning, we bring in the line managers, the executives above them. They view it very engaging because it's your own company. The light bulbs go on with everybody. Oh, that's how we can see our profit margins. Oh, that's how we can validate if our pricing is good, and so on and so forth. Then a couple of iterations within 2 to 3 weeks, a permanent, repeatable production system. The reason rapid prototyping works like this has to do with this graph. The vertical axis is the accuracy of what you might want to know, product, service line, profits. The horizontal axis is the administrative effort to collect the data, calculate the data, if you'll report the data. You'll notice you always have an asymptotic curve where the slope goes up very quickly and then levels off at about 95%, and then further to the right, diminishing returns on extra accuracy for the extra level of effort of work. Stop at 95%. This is management accounting. This is not external statutory reporting for government regulatory agencies. Yes, if you get the statutory reporting wrong, you go to jail. But if you get the management accounting information wrong, you don't go to jail. So it just needs to be good enough, roughly right. Benefit from rapid prototyping, accelerated learning. People get it. Solves the thorny leveling problem. How many activities are we going to have? They typically level out at about 50 to 70 activities, not, thousands of them. And in the past, some of you may be saying, oh, I know that ABC doesn't work because it hasn't worked for other companies. That's because in the past, people didn't know how to right size their ABC system. They were too large, too complex. No one could understand them. They were not maintainable. Also, at the end of that second day with the executives, I asked them, in 3 weeks, when you have your system, what will you do? What decisions will you make? And we basically collect that information because we want them to commit to using the information. I love this cartoon. You've got this answer board. To the left, simple but wrong. To the right, complex but right. Look how few are taking the right path. That's the ABC path. They're all taking the easy path with those labor hours, that distorted information. And notice some are falling off the cliff. The company's going bankrupt because they've got bad information. So let's roll on to the predictive view. What's broken with the budgeting process? It's typically a fiscal exercise done by the accountants that has two problems. It's disconnected from the executive team's strategy. It's not based on future driver problems. It's not volume sensitive. Now, this is a bit of a funny quiz. How many of these boxes would you check for your organization? Our annual budgeting exercise is invasive and time consuming with few benefits. It takes 6 months from beginning to end. We start in June to publish it in December for the next fiscal year. It requires 2 or more executive tweaks at the end. When we give the first draft to the executives, they say, oh, not enough money there, make some changes. Next, it's obsolete in 2 months due to events and reorganizations. It's out of date soon after you publish it. Next, it starves the departments with truly valid needs. Maybe in this next fiscal year, there's going to be a shift to a department. We give them an extra couple of employees. They really need 10 or 20 more employees. Next, caves into the loudest voice and political muscle. That's the gray hairs and bald people like me, the ones that have been there in their 60s for many years. They know how to pad that budget, so they can protect themselves in case they spend more in the next year. Next, it incorporates last year's inefficiencies into this year's budget. The process was inefficient last year. It's still inefficient this coming year. This last one bothers me the most. When a manager is on a glide path 2, 3, 4 months from the end of the fiscal year, and they can see that they're not going to have spent all the money that was allotted and approved for them for their budget, what do they start doing? They start spending needlessly, foolishly. Why? Because they know that next year's budget is going to be pegged to a baseline of how much they spent this year. We call it use it or lose it spending. Let me see if I can describe how you do budgeting in your organization. You give every line manager a spreadsheet January to December with all of their ledger expenses. They fill it out. Then someone in the accounting department consolidates all of those spreadsheets from the departments, and then they bring in the forecast of revenue from the sales. You give that budget to the executives. They say, well, we need more money, make some changes. So you put the spreadsheets back to all of the employee or the managers. They lower some of the numbers back to the accounting department, consolidated back to the executives. That's better, not good enough. Up, down, up, down, up, down, up, down. Come on. We almost want to ask the executives, what number did you want in the first place? So we don't have to go through all this spreadsheet redoing. But that would give us the aspiration of the executives. We want to know what's actually achievable. So I call that what I just described, spreadsheet budgeting. So how do we resolve this and move to driver-based rolling financial forecast? Think about the amount of spending an organization as the result of 2 river streams coming at it. The upper river stream is the recurring, repeatable work. It's going to be demand-driven. Think of it as the customer sales orders. The bottom river stream coming at the organization is non-recurring, non-repeatable expenses, and that's going to come from projects. And I'm going to describe 3 projects quickly, and I'll go in more detail. There's going to be strategy projects to implement the strategy. There's going to be capital projects, which everybody's, familiar with. And then there's going to be risk mitigation projects from the enterprise risk community. So here's the way we solve the upper river stream. The activity-based costing that we look back is really powerful for strategic profit margin analysis. It's all known. But when we go to the predictive view, we effectively calculate the ABC model backwards. We basically forecast the drivers, the volume and mix, times unit level consumption rates, I'll get to that in a second, to calculate how much capacity and spending is needed. So remember my previous diagram, what we're doing for the upper river stream, the repeatable, we're calculating backwards. The way we do this is for the historical view. Remember, the spending's known, we calculate the activities, the cost objects, but we get a bonus. We get, as in addition, unit level cost consumption rates, cost material move, cost per processing a bank loan, cost per processing an insurance company policy. Then, and this is where my industrial engineering 101, I think it was my second semester of freshman year at Cornell University, this formula, the sales demand, volume, and mix from customers times those unit level cost consumption rates equals the capacity required, meaning the number and types of employees and their wages at salary level and purchases, with suppliers. So you've got to think like an engineer. I was at the age 27 a financial division controller with FMC Link Belt in the US. I've been in the CFO accounting space ever since, but I tell everybody I'm an engineer masquerading as an accountant. You need to think like an engineer. Now, for the lower river stream, the non-repeatable work, a real quick primer. Some of you may be familiar with the Kaplan and Norton strategy map and balanced scorecard. Quickly, they've got these 4 perspectives. Each of those rectangles are what are called strategic objectives. We have learning and growth contributes to internal process improvement, which contributes to customer retention and loyalty, which results in the financial results. All of those arrows, those are KPIs. You get what you measure. If you can't measure it, you can't manage it. Okay. And so to really summarize really briefly, what Kaplan and Norton created here was a learning environment, stimulates process excellence, leads to customer intimacy, creates financial value. The purpose of it is basically to accomplish and implement the strategy of the executives. But in each of those strategic objectives, 2, 3, or 4 in the perspective, here are the 5 columns. And what this diagram is showing is who's responsible for what, the executives or the managers. My suggestion is you want to have the executives define the strategic objectives and then delegate it to the manager. So the next step is to identify the projects and initiatives or processes to improve, to accomplish each of the strategic objective, which in turn helps execute and implement the strategy. Also, have those same managers identify the KPIs. Why do we want to do that? Accountability. They're going to be held accountable, so we want them to have buy-in. Now we get back to the target. The executives set the targets. Think of it like a mule or donkey with the carrot, because by measuring every of the managers to meet or exceed their targets, we're basically aligning their behavior and decisions with the strategy. But here's the point. What if we don't give any money to the managers' employees to implement the projects or import the core processes? So this solves, by funding them from the strategy map, we've now solved the problem that the strategy or that the budget is disconnected from the strategy. Now let's move on to the second type of project, enterprise risk management. This is a popular diagram of the enterprise risk management community. Each circle is a type of risk event that will happen in the next fiscal year. The diameter is how much money would be required to mitigate that risk from occurring. The vertical axis is the severity of the impact if the event was to occur. How painful will it be? The horizontal axis is the probability that the event will occur. Now, you can't spend money mitigating every possible risk event, because then you won't make as much profit. So in the upper right corner, the shaded blue, let's fund those. Now, returning back to the upper river streams, I've decomposed it. In the upper river stream, the solution is we'd get the unit level consumption rates from the ABC. We multiply it times the demand, volume, and mix. We solve for the operational capacity required, number of types of employees. For the non-recurring, at the bottom, we've got the 3 types of projects. We do the strategy map, get the projects initiative, fund those projects. We'd go to the enterprise risk management, and we basically fund the mitigation. And then, if you will, the capital projects, which you're all familiar with. So I'm going to decompose this diagram one further. It's a little more complicated, but you'll be able to review these slides at the PDF when you get them. The shaded boxes are the upper river stream. The ones to the left are the lower river stream. Start way down at the bottom, derived budget. Notice what's coming in from the top is that operational. Where that came from was we use the ABC accounting. We get our unit level consumption rates from the top. We get the forecast driver volume from the left. That gives us a capacity resource plan, number of labor hours, pounds, kilograms, number of employees. We then monetize it, whatever is your currency, euros, dollars. From the left, we've got the 3 types of projects: capital projects, strategy projects, risk. Now, we still could incur the same problem with traditional budgeting. Look at the bottom right, I've got that triangle, acceptable. When the executives get that budget, the truly achievable, they may say not enough profit. Well, what do? The risk is they may say, well, why don't we eliminate or postpone some of the capital projects? Bad, we already justified those with return on investment. What if we eliminate or postpone some of the strategy projects? Bad, we won't execute our strategy. What if we eliminate or postpone some of the risk mitigation? Bad, we'll expose ourselves to risk. The best way to lower the expenses is unit level consumption rates, productivity improvement. And that's where the fields like lean management, Six Sigma, cycle time reduction, quality improvement, lowers the process consumption rates. Forecasting. Don't treat forecasting as a special event. I love this cartoon. You've got these 3 men at the table. They say, we haven't forecasted in a while. Maybe we should try that again. Well, you should. Forecasting should be an ongoing part of monitoring the business. But here's the issue with forecasting. Any forecast, well, the vertical axis is the accuracy of a forecast. The horizontal axis is the time horizon. Any forecast would become less accurate 1 day, 1 week, 1 month after we basically produce it. So the issue here is re-forecast at frequent intervals, maybe quarterly, maybe even monthly. And then each time we do that, then we can basically put it back into that previous slide and get, if you will, driver-based rolling financial forecasts. Gives us a pro forma income statement and balance sheet. And some of the accountants that are listening to me, what's the value and benefit of having a pro forma income statement and balance sheet periodically? What's the next step? Net cash flow. And that's what the board of directors, especially during COVID, were concerned about. They want to know the net cash flow because board of directors have governance responsibilities for their organization. Now, we do need to deal with capacity planning. Okay, in the very short term, you would not fire employees on a Tuesday because there's due low workload orders in the house, but hire them back on Wednesday. Of course, you'd keep them on Tuesday. You just for a short period, you'd incur idle capacity. But as the time horizon goes out, you might replace full-time employees with temporary workers or contractors. You might lease assets that you might have purchased, and by leasing them, then they become variable, not fixed. So the diagram at the left, you can see that the effort level, the vertical axis to adjust capacity, very short term, it's difficult. Again, we're not going to fire employees on Tuesday, hire them on Wednesday. But as we move out weeks, months, years, we can get more variable expenses. So to the left, there is our historical looking through the rear view mirror, of the ABC system. But to the right, I've now got diagrams showing that as we go to the predictive view through the windshield of the car, you notice that there is more and more variable expenses, less and less fixed expenses because we make them variable. Step fixed, resources come in discontinuous amounts. You can't purchase a half a machine. You can't hire a fourth of an employee. It's all or nothing. So each time we bring on that piece, it's step fixed. I'm going to skip these, just real quick. The issue here is where we're really leaning to when we do this predictive accounting is marginal and incremental expense analysis. Now, some of you may remember from your textbooks when you were in the college or the university, it was called the relevant range. So, decisions are only impacting the future. So examples where we need to use marginal and incremental expense would be if we want to add or drop products or channels or customers, make versus buy decisions, outsourcing decisions, a capital investment, and then the rolling financial forecast that I just described. In the interest of time, I'm going to skip this slide, or you're welcome to look at it at your leisure. I want to basically move, as I start to summarize, a diagram that I created for the International Federation of Accountants. Many of you may not have heard of IFAC. It's IFAC.org. They're in New York City. They're like the United Nations of Global Accounting Institutes. I think they have like 50 of them. In the US, we've got the AICPA, the Institute of Management Accountants, which I'm actually a 30-year member, CIMA, which was out of London in the UK. And I told them I could create a taxonomy of the big world accounting, like in biology, plant kingdoms, animal kingdoms. So in this diagram, notice there are 3 kingdoms of accounting. Tax accounting, in the middle, financial accounting, and then to the right, management accounting. Now, and notice the source data will always come in from transactions from your accounting systems and your operational systems. Now, I want to distinguish expenses and costs are not the same thing. Expenses are when your company exchanges money with third parties, pays suppliers, pays employees. It's like writing a check. Currency exits the treasury. All costs are calculated. So a process cost, a product cost, activity cost, and so forth. So that's the cost measurement. Now, notice when we go to the left under financial accounting, we follow generally accepted accounting principles, GAAP. They are rules. And that's what satisfies, the audit, inventory, valuation, and the like. But for management accounting, we don't follow those rules. Remember, we don't do that butter spreading, which satisfies the audit. We trace and assign with cause and effect relationships. That gives us the cost reporting and analysis for profitability analysis and so forth. But now this whole topic that I present to the right is about the predictive view, decision support, and cost planning. So the driver-based budgeting, rolling financial forecast, what if scenario analysis, sensitivity analysis, back to our system, we could increase an assumption 10%. What's the impact? Sometimes accountants are not fond of me. They don't like me because at the bottom, I've got the value continuum. Notice to the far left, low value add. So the accountants that are just closing the books and reporting to the government, it's low value add. The value of accounting increases as we go from left to right. And notice the highest value is what I described in this presentation. It's the predictive view. Okay. Now, I have a big picture of how does all the enterprise and corporate performance management methods look on a single page. This is my diagram. Real quickly, think of this like your heart and your blood flow system. We've got the organization, that's all of your assets and your employees, people. Notice at the top, we've got the customer loyalty, but we've got an arrow that's going all the way to shareholders and owners. That's the real message here. Customers are the source of value, wealth creation for shareholders and owners. We need to connect them. Okay, let's go to the customer loyalty box. To the left, there's the strategy and mission. Remember, that's the executive's job. Set direction, answer the question, where do we want to go, and create the strategy. We communicate it then downward with balanced scorecard KPIs. That gives the feedback to those managers who every day turn on their computer screen and they look at the dials of their KPIs. They could answer the question, how are we doing on what's important? Okay. Now, CRM, customer relationship management, what's going on there? The sales and marketing need to answer the question, what type of customer is more attractive to retain, to grow, win back, and acquire? Which types are not? So that's where the customer profitability information comes in. Now, that counterclockwise circle, this is the process world, process improvement. And it's a universal end-to-end process. Take the customer order, complete the order. See, it's a circle. That's the area of better, faster, cheaper, if you will. Where's management accounting and analytics in my diagram? I deliberately omitted it because it's the output of management accounting analytics is pervasive and is everywhere. So to now go a little further into the diagram, notice we start with customer satisfaction. The executives will formulate the strategy based on the needs of customers, communicate it with risk management, strategy map, KPIs. That gives the feedback to the managers. Now we've got the targeting, help sales and marketing answer that question, which type of customers attractive, retain, grow, win back, acquire, which types not. Then we've got that order fulfillment, better, faster, cheaper. So all of this, think of this like veins in your system. The stuff is flowing through all along. I don't know whether you can see these bubbles flowing because I'm not in my view, but this is happening every minute, hour, day, week, month, year. And so if any of those veins is constricted, I call it arterial sclerosis of the EPM corporate performance management system, then all of the money doesn't go to the shareholders. It leaks into the sewer. So think of this as a vision of where you want to be with your organization. You want to implement ABC, you want to implement strategy maps, balanced scorecard, you want to implement all these, and don't wait 2 to 3 years to do it. Do it in the next 6 to 18 months using rapid prototyping techniques. If there are any consultants listening to this, please directly communicate with me. I will share with you how to implement these rapid prototyping methods so you can deliver them to your clients. to start concluding what's really happening here is there is a shift in the source of return on investment from tangible assets to an intangible assets. What I mean by that, the shift in return on investment is shifting from buying trucks or machines or computer hardware, software to an intangible asset like information. And you'll notice in this diagram, as we go from left to right, we go from data to information to knowledge to insights to decisions. The problem is many organizations are stuck in the first two red bubbles to the left. All they have is raw data and standard reports. All they can answer is what happened. Now, in some cases, the third red bubble, the IT director will provide some managers with what's called business intelligence software, BI software. As an example would be like Qlik, Qlik, Tableau, which was acquired by SAP, SAS, SAS, my employer. SAS has 15,000 employees, world's largest privately owned software vendor. But even once with that BI, where you can still drill down to an anomaly of a line item of an invoice or purchase order, you're still restricted to only know what happened. Corporate performance management begins with the first blue bubble, modeling. Costing is modeling. Costing is not key accounts and journal entries. Costing is understanding how that flows. Remember my multi-stage cost assignment network. So now we can answer not only what happened, why did it happen? WHY, the causality principle when used in any type of reporting modeling, gives you the why. But we're still in the rearview mirror. Now we go to predictive modeling, which was what this webinar was, through the windshield of the car. So of all the choices we could have with the descriptive modeling, all the scenarios, we can start saying what are the possibilities. And then we get to the top. I call it Mount Everest, prescriptive analytics. Think of it as optimization of all the choices and the scenarios we might have, which is the best to do. So I'm going to conclude with the frustration that I have. What is taking so long for organizations to implement these methods? But before I do, I want to describe another diagram paper I created for the International Federation of Accountants. After I did the taxonomy, remember the 3 taxonomy, they said, can you do a stages of maturity of that someone can assess what stage of quality of their management accounting system? And if you go to that link in this slide, you'll be able to get this report. It's about 30 pages, but briefly, here are the stages of maturity diagram. Oh, a lot of people say they always have to be 5 stages. Well, I'm sorry, mine's 8. But what I do know from doing a lot of evaluations is 95% of organizations are at a 5D or lower. They're just doing that standard, that cost accounting, spreading the butter of the overhead. 6D starts ABC, 7D, we get to profitability, customer, and so forth. To the right side, 1P, this is now the predictive view through the windshield, is that spreadsheet budgeting. Remember, up, down, up, down, up, down. And then we move upward 2P, 3P to what I described to you. So my frustration, what is taking so long? One of the barriers are technical barriers, dirty data, low quality data, but the IT department has a tool called extraction, transform, and load, ETL. It's like a water purifier. It can clean up the data. Another technical barrier for companies that have multiple divisions, like in India, like Reliance Electric, huge, they may have different hardware vendors, Dell, IBM, Hewlett Packard. IT can fix that. The second problem is the perception barriers of excess complexity and affordability. Remember when I asked you, maybe we should put in ABC, but you had all these misconceptions, timesheets, 3,000 activities. I showed you with rapid prototyping, you can implement ABC in 3 weeks. By the way, if you're interested, I have another rapid prototyping. You can implement a strategy map and balance scorecard in 2 days. But the biggest barrier has got nothing to do with technology, nothing to do with methods, nothing to do with systems. It's all about people. It starts with resistance to change. It's human nature. People like the status quo. People don't want you to rock my boat, But other issues like fear of others knowing the truth. I don't want the other departments to know my costs. Fear of being measured. Fear of being held accountable. Weak leadership. There, I said it. Not every executive team's got the highest IQ. So if you want to be successful, you're going to have some soft skills, behavioral change management skills to basically get the buy-in of people. Now, here are many of the excuses from preventing organizations from being progressive. We are profitable, so why does it matter? Well, you may not be profitable going forward. We'll purchase software that'll fix our problems. The software is just a tool. And I like to say a tool with a fool with a tool is still a fool. You got to use modeling skills. We already know our true costs from our general ledger reporting system. No, you know your true expenses. You don't know your true cost. You have to calculate the cost. We have done it this way forever. We don't do that here. We already know everything. It is in our heads. That's pretty arrogant. Resistance to change. We are a small organization. We'll worry about better methods when we get larger. Well, you may not get larger. And incidentally, people ask me, how large do you need to be these methods? I say 25 employees. You don't have to have hundreds and hundreds of them. If you have 25 employees, you're already at the size that can apply all these CPM methods. Next, all this hype is just made up from highly paid consultants. Well, let me defend the consultants. They can do something most people cannot do. They can focus. They have an engagement letter with a deliverable and a timeline. They got to get that project done. Next, no one looks at the reports I create, so there is no point generating better reports. That's sad. Here's an accountant that's producing a good report. They give it to their managers. They throw it into the trash can. Next, we cannot afford better software to fix our problems. The commercial software vendors that specialize are not that expensive. You can contact me. I can give you a list of the content of these software vendors. Next, we are way too busy doing other things. Well, that's closing the books. Maybe it takes you 3.5 weeks to close the books. We'll close the books in 2 weeks so that you've got time to implement these methods. And finally, we don't know where to start or how to get started. Well, I've already given you a clue: rapid prototyping with iterations. So to conclude, this left side is a cover of one of my books. And notice it's got gears in it. And the analogy here is, imagine that in your company, some of the teeth on your gears are broken. And all these gears are all the various methods: strategy map, activity-based costing, risk management, so forth, process improvement, lean management. So imagine some of the gears are disengaged, teeth are broken, maybe even someone threw sand in there. Put that into your automobile. You will have your car can run, but your fuel efficiency will be low. Now look to the right. Titanium gears meshed together, spinning faster revolutions per minute, lubricated, digitized. Now put that in your automobile. What's your fuel efficiency? Much higher than the one to the left. Now replace the analogy or metaphor of car fuel efficiency with rate of shareholder wealth creation. When we integrate all of these various methods and actually embed analytics of all flavors, regression, correlation into them, then notice that the line, we make the revolutions per minute, RPM, of the corporate performance management and business analytic gears spin better, faster, cheaper. That's the process improvement. Safer, that's the risk mitigation. Smarter, that's the strategy map with the KPIs. So, action steps: get educated. Thank you very much. You're doing that by attending this session and this entire summit by Fruition and Data Labs India. Get buy-in from those that are going to be resisting change, and almost all of them are. Rapid prototyping, start small, think big. I always say that first model is the beginning of crawl, walk, run, fly, soar. Improve incentives. I don't have expertise in motivational theory, but I know that it's important. There are 3 links when you get the paper that can go deeper. Your success depends on how well and how fast the right information intelligence gets to the right people. Thank you very much, Data Labs India, Sheikh, Deep, for inviting me to be a presenter. I don't know where we are, if I ran over time. I know I started late, but.
So we have a few minutes, Gary. So we have a few minutes left. So because we started a little late, so we can have few questions clarified. Okay. So. Yeah.
Okay. Let me just say, often I don't get any questions, and here's why. It was overwhelming. It was, I call that speech like an MBA in 1 hour. If you look at the curriculum of any of the business schools, like in the U.S., Wharton at Penn,
Input
Stanford,
video.
Harvard, you look at the curriculum, you'll see profitability, you'll see planning, blah, blah. You'll see all that. I just covered those in 60 minutes. So it's overwhelming. So it won't surprise me that no one has any questions.
Yeah. So we do have some questions. Yeah, but Deep, can you just close the presentation and put the video so we can see?
Okay, I just did stop sharing.
Yeah. So basically, activity-based costing and activity-based management, it's very important. There is no question about it. I think people understand it. As you said, it's not the concept, what is the problem. It's a how to do it. Many people are comfortable with some very easy process, which is the classical accounting. Okay, so and maybe they are not interested in activity-based management or activity-based costing or whatever, because it will expose their inefficiencies. Okay, so that's exactly what I see, because finance team, they are very comfortable in doing the fixed cost, variable costs, and okay, and they live reporting in a standard way, capital expenditure and operational expenditure, but they don't go by evaluating activities. What is their justification is these activities might not be correctly defined. So that's their justification, the accounting people. But actually, as you explained very nicely, it's not that complex, and you don't need to be very accurate. So even if you are directionally correct, so it will unearth many of the inefficiencies in the organization. But still, I keep reading your work, and Kaplan wrote an article in activity-based costing a long back. Okay, and there is another book also, time-based activity-based activity. Okay, so but people still adoption is not proper. I don't know the reason. I personally like it, and we do some simulations in IBM Cognos, TM1 models, but still, people are not receptive. So what do you think? Like, is this more the activity-based management concept? Is it very receptive in the United States? What do you think, Gary? Mm-hmm.
It's the acceptance rate is increasing, but at a rate that's too slow for me. The vast majority of organizations are yet doing. But let me just probably insult many of the people that are listening to me. For those accountants that are reluctant to implement ABC, I think they're irresponsible. Irresponsible. That's a strong word. Why? Their managers deserve much better information because they're the ones that need the insights to make better decisions. And so when the accountants are providing flawed and misleading information that could be 20, 30% error, in other words, a product that is $100 US in reality is 140 or 30. Come on, but the accountants, a lot of it is their misconception that it's too complicated or it's too big and it's not worth the effort. And that, there's just a lot of, I call it excuses and barriers. So, and then part of it is it's got a bad reputation from the past because when consultants did implement ABC in the last 10, 20 years, they were too large, too complex. Sometimes the the consultants wanted billable hours, that what the partner wanted to make a lot of money. So let's do 6 months, so it really messed things up. You've got to be practical. And you're correct. Kaplan had a phrase, it's better to be approximately correct than precisely inaccurate. It's better to be roughly right than exactly wrong, which was that cartoon with the signboard. So most of the...
One simple litmus test is majority of organizations, they don't know profitability by customer. The simple reason is they cannot measure profitability by customer. All they do is they just put everything in one basket and then come up with the bottom line, and they are quite happy with that. So which product doing better, which customer is doing better, actually they don't know. So that's exactly the problem.
Yes, and when you asked what's the adoption rate in the U.S., I think moving towards measuring and managing customer profitability is going to basically bring more interest in implementing ABC. You can stop halfway down the income statement with just product and service gross profit margin. But what's going on below that line is channel distribution expenses, marketing expenses, selling expenses, cost to serve. I can make a case that that stuff below the line is far more important, because what's above the line, oftentimes customers view suppliers' products as commodities. So there's not a real competitive edge there. So for a customer to really get better, you've got to provide differentiated services to different types of customers. It's all about differentiated services, and you got to know price discounts, coupons, deals, offers. You know, that's what marketing and sales is always thinking about. How do we entice a customer to buy more from us, or so forth? So the accountants have a huge opportunity to bring value to their enterprise. And many of them just got to, what we call, get off the dime, get out of your chair, stand up and get involved and contribute.
Yeah. So one of the maybe a very brutal comment is the quality of accounting people are not going up. So it's almost staying the same for so many years. Okay, I think Khalid has a very important question. So Khalid Noor, he's an ex-CFO. Okay, so a very large pharmaceutical company. He posted one question. So overhead allocation plays havoc with the decision making. In case of underutilization of capacity, how do you do product costing? So that's a question.
I didn't quite understand that question. Oh, here it is. Overhead allocation, please. Oh, it gets. There's a sophisticated way to actually calculate unused capacity, and there's not enough time for me to go into it. But idle capacity or unused capacity, but there is a way to kind of separate that out, because you don't want to overcost products or services. If there's unused capacity, the products didn't cause the unused capacity. So again, and you have to think like an engineer. That's why, the most successful implementations typically have industrial engineers as the project manager, and the accountants are kind of like working with them. But the process people, the lean management, they're the ones that naturally are drawn to sophisticated or progressive management accounting. They can understand management. I do want to make a point. The universities are a little bit of a problem here. The university faculties are not very effective in teaching the students how to do activity-based costing. And so the problem can actually start at the university.
Yeah. So in my opinion, if the capacity is underutilized, it is not the problem of product. Okay, so you need to manage it. You need to find a way, but you cannot put into the cost and put the cost to the customer. It's not the right thing.
And if you've got unused capacity, then whose job is it to fill it? Sales and marketing. Fill it with more profitable products and services from customers. So everybody's got a role with this game. But what the accountants need to do is provide visibility. I'm going to end with just two comments. The first one is, I believe in the past, the best leaders and best executives had the best answers. Today, I don't think that's the case. Today, I think the best leaders and best executives have the best questions. There's too much complexity. There's too much volatility. There's too much uncertainty for them to rely on their gut feel or intuition or types of answers they had earlier in their career that got them promoted to the high levels. They need to create a culture of investigation and discovery and tolerance for making mistakes, as long as you learn from them. And then let me end on this regarding what ABC does. It gives visibility and transparency. And the way I describe it is this: in the land of the blind, the one-eyed man is king. In the land of the blind, the one-eyed man is king. So,
one eye is better than nothing. So thank you, Gary.
Right.
Thank you, Gary. Have a wonderful day. So thank you for joining, and wonderful lecture. It's very insightful. Each time we hear, we get something new from you. So thank you very much for joining us. Okay.
Bye.